when we're looking at days like today, where the economic calendar is kind of anemic, it doesn't really have any kind of economic drivers that would be medium impact or high impacts. It's really forcing you to look at just pure price action. And that in and of itself is not bad, but how do you engage that? Like, what do you do? What do you look for? Well, I purposely kept these old PD arrays here because they're from last week. Okay, and you can see the reference points here. This is the first presented fair value gap from January 2nd. Okay, so that's 2 Fridays ago. So it's not last Friday, but the Friday prior to it. Okay, and I have it graded. These are only eighths. Okay, and you can see the sensitivity around all the eighths and the regular quadrants that are based on quarters. But I don't use that information except for targeting. If I can see a diagonal trend line, whether it be viewed as supposed resistance or support, when it's clean like that, when it's obvious, and it's diametrically opposed to what I think the market's most likely going to do next, I'll target those types of things. Otherwise, I'm looking for clean highs and lows. So Asian session buy side liquidity. Okay, and why is it being called that? And why is it important? If you look at all these highs in here, look at the time that high formed. It's 10 o'clock in the evening last night during Sunday's Asian session. Now, that's not the Asian session kill zone. Okay, Asian session kill zone is 7 a.m. to 9 p.m. Eastern time. That's like the sweet spot for trading. It's like a nice little 2-hour window where you can go in here and scalp and get something. There's usually always a first presented fair value gap in that you can use. There's always some old high or old low it can run for, and I'll look at that in a second. But for now, just let me cover the point of why I'm calling it the Asian session buy side liquidity. Asian session ends and closes around 5 a.m. Eastern time. Okay, so that's about right there. Okay, so if this is our delineation for Asian session close, and this is for Forex, for equities, index futures type thing, that's your delineation right there. So what you want to do is visually represent a starting point of that, and then go back through Asia session. So 7 o'clock in the PM, 7 p.m. Eastern time. Look for the obvious smooth highs or lows. This was highlighted before the stream began with me talking, so you watch it, you can see it, and that was the draw on liquidity. It's smooth. Okay, and this high here, while it did take this short-term high here and rejected that, they left that. That's engineered liquidity. Now, engineered liquidity is where the market will run to an obvious level. Whenever a level on the chart looks like a perfect classic scenario of what every textbook shows as a resistance or a support level, they always show it like this. High, 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 high. They're going to say that's a strong resistance level. Now, while I'll admit at that moment when it starts to drop down, that would be considered a present nice resistance level where price was unable to overcome that. I'm not looking at price when it's creating these types of things here and trying to trade that, because you don't know if they're going to run through that as a new trader or if they're going to continue dropping lower. You don't know that. So that's why I don't teach that way. What I do is I teach you to look for it in the past, because that's the trap. Whenever you're looking for smooth highs like this, and it's framed on the basis of time. What does that mean? Well, the first primary function, what we're doing is we're looking for times in the chart where smooth highs and smooth lows or single highs or single lows exist. And I'll tell you what that is by contrast. But for now, just look at this and know that this is too smooth, and smooth areas in price action tend to become or made jagged. And you can see the price was meandering around off of some random box here. I probably just scribbled that on there from just, guesswork. And it rallied all the way up and traded into that smooth area. Look at the reaction it's been since then. So smooth highs and smooth lows during sessions. So what does that mean? Asia, the entire Asian session. Go through the whole gambit of the time. So that would look like this. All right, so the entirety of that range during Asia or the Asian market. Sessions are not, this is not the kill zone. This is the entirety of the session. So there's a difference. When you look at the entire range, that's available, you would include all of this. So that's the Asian session high, and that's the Asian session low. See the difference between that and this? But this is the entirety of the Asian session kill zone. See the difference between that and this vertical line and that vertical line? When you're looking for smooth highs and smooth lows, do not, listen to me, do not limit your perspective to only that of during the kill zones. You're going to find really good setups for that to, act as a draw on liquidity. But what happens if you already went outside that range, as we seen here? If you're only using my kill zone to look for the liquidity runs on relative equal highs or relative equal lows, this has already been used and it's useless to you, right? Because we've already went outside of that. And what I'm basically saying to you is there's nothing inherently wrong with limiting your search for relative equal highs or lows in that kill zone or any kill zone, like the London kill zone. That would be 2 o'clock in the morning to 4 a.m. That's your sweet spot, but it goes all the way to 5 a.m. Why? Because it's an overlap with Asia's close. Ooh. So you want to have that 3-hour window between 2 a.m. Eastern time to 5 a.m. Whether you're trading Forex, whether you're trading index futures, it's the same. It's the same. So when we're looking at the entirety of the Asian session, session is not kill zone. Okay. If it was just that easy, I never would have said kill zone. Kill zone is a very specific time during the overall broad brush concept of where are we at in the world globally trading right now? Well, it's 7 o'clock in the evening Eastern time. Asia's coming on board. And that session usually winds down and closes up shop at 5 a.m. Eastern time. But during that time, you have the European session that's trading, and it usually closes around 10 o'clock, 11 o'clock in the morning Eastern time. So if you're going to be trading PM session, afternoon equities, NQ, ES, the dirty 30, don't go hoeing. don't use Dow. Okay, because it's unruly. So if you're looking for ranges to determine very obvious clean highs and clean lows, okay, if you look at it from a broad brush perspective like that, don't just limit it to the kill zones. Look at the entirety of the range, and you're going to see where's the obvious smooth level. Well, looking back, can you see how that's obvious? How retail traders would say, look at this, if I was writing a book on support and resistance only, and I wanted to use a classic example of it, this would find its way in that chapter or segment of the book because it's showing clear, obvious hindsight resistance. And that's where the advantage is because retail traders are taught to think that these things repeat. I guess in a way, sometimes it does, okay, but real smooth highs versus where's the smooth lows at? This was the low during that Asian session, not kill zone, okay? So we have this low here, which was going to be what? Think now, kill zone. This is the London open kill zone session low. So that would look like this. That's what everybody's really watching in the financial industry. So we go to 5 a.m. Okay. So that right there is your London open kill zone, not session. That London session goes till 10 o'clock to 11 o'clock in the morning. But where do you start from the beginning? Like, where's the beginning basis point? You have to look at time first. Where are you highlighting the bookmarks where you frame the reference of time? And then inside that window frame, which we have here delineated for Asia, vertical line here and here. And then for London, this is your beginning point for the close of Asia and lunch for London. And we'll do 11 a.m. There you go. So beginning 2 a.m. And this is what you would be using reference for the PM session. Every single day, if I'm looking at PM session trading, if I want to consider PM session trading, this is the first frame of reference I'm looking at because I want a broad brush perspective. My chart would kind of be focused like that. That would be the reference in time where the highs and the lows, or wherever relatively smooth highs or relative equal lows would be. Inside of the range here, let's just assume for a moment that it's 9:30 p.m. Eastern time, which it's clearly not. If it were 1:30 p.m. today, this is the range in which I would look back through it and say, okay, where did they leave smooth highs and smooth lows? I'm not just simply looking at the highest high. I'm assuming, for the sake of example, let's assume that this was the highest it goes between, you know, 2 o'clock in the morning to 11 o'clock in the morning today. We still have some time to make that higher high here if it wants to. I'm just saying, by example, let's assume for a moment that this is the highest high it forms, and this is the lowest low it forms. What I would look for is inside that range, relative to that time, the time aspect that's been utilized already, because this high is higher than the highest high prior to it forming is here. So between this vertical line at 2 a.m. and this vertical line at 11 a.m., I'm looking for the highest high and the lowest low, and inside that range, because the time aspect is now complete. Now I'm looking for the price aspect. So it's first time, then it's price. So now what am I looking for? I'm looking for smooth lows, because everything it's been pushed up to the high end. So we're in a premium market. So the first thing I want to do is say, okay, if it's going to go higher, now listen, folks, if you start a session and it's been moving one-sided, whether this market continues going higher or if it reverses and goes lower, it's still optimal to look for something that creates a relative equal low in all that price action. Because for the sake of argument, let's assume that the market's going to continue going higher. It's more likely for the market to drop down and disrupt the existing market run, knock out weak bulls. And how would they do that? They would target a low, relative equal lows. Then once it goes down there, it could resume going higher. Or you could just use that as the basis for that's what you want to be short on, and you don't care if it continues going lower, and you don't care if it reverses. That's the mindset I cultivate with new students. You're not trying to ride the entirety of the move. You're not trying to be right. You're looking for the easiest low-hanging fruit objective. What is it likely to do next? You're not reacting to anything. You're predicting. That's what you're doing when you win. This is a statistical probability in your favor if you do these types of things, looking back through time, looking for smooth highs and smooth lows, and then limiting your focus to just simply looking for a setup that would yield a run into that. And this is the London open kill zone. So we have the high here and the low here. After 5 a.m. and we entered 7 a.m., and this is when you want to start expecting pre-market session trading. You can do all of your setups between 7 o'clock in the morning and 9 o'clock in the morning and never, ever, ever, ever engage the 9:30 opening or opening range. People are afraid to trade it because they don't know what they're doing. And that's what I'm teaching you today. I'm teaching you how to work within it, look for ranges to run for liquidity, because that's what this is doing between 7 o'clock in the morning and 9 o'clock in the morning every single trading day. Every single trading day. It's going to do this every single day, flawlessly, without fail. It's going to do it. You can set your watch to it. It's going to do it every single day. You don't need anything except for understanding what I'm about to say here. And you can encapsulate everything you would ever hope for if you have the time to be in front of the charts and look for it. Blue box is the London session opening kill zone. It's very specific because it's 2 a.m. start time and 5 a.m. close. 4 a.m. is the sweet spot. Okay, that's where your purest little runs that start or begin for the setup inside of the London. So if you're a London trader, if you're up at that time, okay, it doesn't mean you have to be living there geocentric, but it means that if you're focusing on that time of day, you look at 2 o'clock to 4 o'clock in the morning. And after 4 o'clock in the morning, unless it creates some kind of parabolic run to a higher time frame PB array, as you see it does down here, that green box is that daily suspension block high. And I'll draw out to a daily chart and show you where this all fits and all that. But you can see it drops pretty aggressively down into that, and it does form the low at 343, which is probably convenient because it fits inside the time window I'm telling you that these things form. But that low reacts off of some random goofball of a range that I put on the chart, 2 weeks ago and showed you, look at this, pay attention to this. And it's an old level. It's a stale level. And it's not a classic support and resistance level, boys. It's the top of a volume imbalance that's part of a buy side imbalance, sell side efficiency, which is not a liquidity void. Okay. So that reaction there, if it's running here and we close up shop kill zone wise, there's a gap of dead time. What does that mean? We're not doing anything from this point here to that. All of this information here, while somewhat useful, I'm not trying to engage in that. Now, so if you're listening to me to learn, avoid this area because it will keep you out of troubled waters. Wait until 7 o'clock in the morning. Then the price action cleans up. It gets real nice. So what would that look like? At 7 o'clock in the morning, here's first presented fair value gap. And we already had on the chart at the start of the stream before I even talked, we were looking at that clean level in the chart. So first presented fair value gap in pre-market session, it forms, trades down into it here and runs to the clean levels here. So bread and butter setup in pre-market session time, discount array. Why is it a discount? Because where it's at in respect to the level that's relatively equal highs, that run, that's a small little range, but it's a bread and butter type setup. Why are you not looking at that little gap right there? Because that's not displacement. Watch. This little thing here, cute as it is, that is not important to me. I would look at that as a common gap. This is not common. So a common gap is not an interesting gap to me. An interesting gap is one that has displacement like this. And what is displacement? It's a run through a high or low at a very specific time. What's the time? 7 o'clock in the morning. So now business should start picking up. Okay. And we know that there's a clear level of liquidity up here from overnight Asia session. So all of this here is a draw for price. As soon as 7 o'clock hits, I'm thinking I want to see something that's going to give me a run up into that level. And look how they reacted after being there for a little bit of time. This displacement towards the obvious retail concept. Okay. So if it's a relative equal high, as it is in this case here, this is the Asian session, buy side liquidity. It's the smooth highs inside of all of the price action from 7 p.m. Eastern time to 5 a.m. Eastern time. So that entire window, we're looking for where is it obvious that it's left smooth highs or smooth lows. In this case, it's smooth highs. Why? Because overnight, we only saw the market go down. So whatever discipline you have, if you look for what price has done overnight and then look for the smooth highs or lows in that range, you're going to have pre-session or the first hour of trading's point of interest for index futures trading. But you have to have a framework. You have to know why price should be considering your level of interest. Why is the fair value gap of importance? Displacement is where we take out a short-term high. Boom. If we take out a low, here, that low, this is a noteworthy sell side imbalance, buy side inefficiency. But let's assume for a moment, let's say you're bullish and you think that NQ could continuously go higher, but you have this. What do you do with that information? Do you try to short it there? No. You look for it to act as what? Inversion fair value gap. So then you would frame it and put the levels on it from the high, upper quadrant, midpoint, lower quadrant, and the low. And then you would study, and does price give you evidence that it's using it? Is it supporting that idea? If it's in a consolidation like this, it's less likely to give it to you because we're in a holding pattern right now. Because why? Why is it just sitting around here like this? Because the session, 7 o'clock to 9 o'clock in the morning, has already done its initial job, which is run to overnight highs that were clear, they were obvious. Retail has seen it as resistance. They trust it, and it's going to run for the liquidity that's left up there. And that's where you get that run here. So it's not that it's an engulfing candle, okay? Because this candlestick here, one right before it, is has no bearing on what I'm looking at. I'm looking at this structure there. Low, high. This short-term high here was pierced with that high. And then this low and this low, relative equal, had it pierced there. This high, that low, and we're at 7 o'clock. What do we do next? Well, am I interested in seeing this low get taken out? No, because the smooth high is up here at Asian session buy side liquidity. That's these highs here. And this one here is the trap. This is what throws off people. They're like, look at that, man. It couldn't even get up there. So this is strong resistance. I love that because what is this really the way I teach? They're relative equal highs. And it's high probability because the one to the right is lower than that one. That's the trap. That's the retail trap. That is the thing that you're looking for. Okay. You want to see that type of thing set up leading into 7 a.m. because then you'll have always something to do, whether you're practicing reading the tape or you're not really doing even a demo account entry or nothing like that. You're just watching and observing. And by having the stream started and it had like 12 handles before it ran up and took out these levels, the confidence that it yields to you by doing it, it helps with you knowing what you're looking for. And then it communicates to your subconscious that doing these subtle things doesn't require a whole lot of acrobatics. It doesn't require a whole lot of thought process. They're very simple things. This is very simple logic. You are looking for a framework of time and you're looking for where is it smooth? Where is it like obvious that it is respecting some specific price level? And wherever your eye jumps to where it's smooth, that's many times what you'll see the pre-market session, 7 o'clock to 9 o'clock in the morning, run to. Now, let's play devil's advocate for a moment. And let's assume that all this smooth price action up here, say that didn't get ran to, and it came down and it traded down into this first presented fair value gap from January 2nd. I would expect 930 if this hadn't ran up there as it has already done. Then any drop down would be viewed as a Judas swing during the 930 opening to 10 o'clock opening range, that 30-minute window. And then I would look for displacement to the upside. And if it was done on the basis of the first presented fair value gap, then I would use that there and then run up to that. And that's how I would use that during the first hour of trading. See the difference? Okay, so having scenarios, and I'm talking in hypothetical because what I'm describing has already happened here. So I wouldn't expect that type of thing because it already ran for that liquidity. So what you're looking for is now inside of the 2 a.m. to 7 a.m. That is your pre-market session, but including overnight London session. So you look back through that range of time between that and that vertical line. Where in that range between these two vertical lines, where is there anything that's smooth? We've already taken out the high overnight here. We've already cleaned up and purged the Asian session highs. Does that mean it's going to drop and go lower? It could, but I'm trying to kind of like cultivate that idea that who's made money right now? London low bulls. So between that low and what we have seen here as a high, go back through with your eye and look for relative equal lows. I like this. It's a nice block of price action there. And then I like this area here. And it's also the consequent correction of first fair value gap of January 2nd. And the further we get down, because I'm admittedly, I'm still bullish on the daily chart. We can see objectives to reach for. Now, just because we have a level that we anticipate that may act as a draw on liquidity because it's a relative equal high or relative equal low, don't marry the idea. Be aware that that might not be accurate for the session that you're watching. It may use it later on. For instance, like London here, you may have looked at this area here and said, look at this is first present to fair value gap. It's 2 a.m. Let's trade it and then reach for these smooth highs. And it just falls short. The reason why that I teach partials because this type of thing here can happen where there's a high, it runs above it, but your objective doesn't get met until a later time. And if you're buying that fair value gap there, you can't weather that type of retracement, which is why we use stop losses. But if you don't know what you're framing in terms of time, you won't understand where the liquidity is presently. By framing the references in time, the kill zones and the session highs and session lows, and relative equal highs and relative equal lows, you will know where the bigger bubbles are going to be at. And what is an example of that? Well, we have smooth highs over here. That high that failed to breach it. So there's going to be a lot of liquidity sitting there because new positions were entered there. And existing stops here moved down to that high on shorts. So that logic tells me that this is a larger pool of liquidity. It's much more impactful and it's going to be a stronger draw. And it just so happens to be just shy of that level there. So if it's going to take out that high, it's going to definitely come back up here and sweep that out. And it's a relative equal high because of the definition I give it, which is it gives you a run to a level, it falls short of it, and then it gives you this little red herring run. And I love that. I love that because they're so easy to see, very simple little runs like this bread and butter setup in here. This is not the first present fair value gap. That is. So when you're watching the 9:30 to 10 o'clock in the morning, I'm looking for the obvious displacement fair value gap. Like if it, another rule of, general rule of thumb, if it's less than 10 handles in NQ, chances are you're already 80% likely that that's not the first present fair value gap. Now I'll say it again because everybody went right over your head. If it's less than 10 handles, chances are I'm not using that as first present fair value gap. I'm waiting for another fair value gap to form. That's why sometimes you've seen in my examples, why did you use that one there and not that? Now you know. Knowing what you're looking for, where to frame it, on what basis, first on time, it's crucial. It's important to know what you're looking for and where you're going to find it. And that's what I'm showing you here today. So can you see this diagonal business here? In my mind, I see that as retail traders drawing a line from that low up through these lows up into here, and they see that as diagonal support. In my mind, I think to myself, well, we ran straight from the low at London low to where we went to the liquidity here. And if this is being shown visually where a trend line could exist there and it looks like textbook, then I look at, okay, they might utilize that in the opening range or in the first hour trading. So I see this and I'm like, okay, where's the midpoint? That's this liquidity right there. So I would like to see if this doesn't get disrupted before 9:30 opening bell. That to me is an area that liquidity right there is interesting. Why? Because retail sees this as support and diagonal support and resistance. Again, Tori, I love you. I'm not trying to beat you up. It's not meant to upset you or anyone that believes what you do. I just personally look at that and say, I'm going to attack that at the right times. Okay, if it's there and everything is yielding a setup that would go against this logic, that's what I'll do. But it helps me frame pools of liquidity that are just real easy bread and butter type setups. And you can see, since we hit that liquidity, that was Asian session buy side liquidity, what has it been doing? It's in a holding pattern. Okay, what is this low in that low? Here to there. That's a relative equal low. Now, if it wants to dive down in there and disrupt that, that liquidity is the one I'd be looking for. But caveat, that low has a wick, or in this case, a shadow, okay, or tail. This little bit of business here, you want to make sure that you grade. I'm not going to do it with mine, but you want to grade that lower quadrant, consequent encroachment, upper quadrant. And if it takes out that low, it could only just go down inside this wick to the lower quadrant or the consequent encouragement of it. So not every relative equal low or relative equal high is the same. If your anchor point that starts the determination whether it's a relative equal high or a relative equal low, that means the furthest one to the left. Okay, this is a swing low, this is a swing low. If you're referring to that as the beginning point of defining your relative equal low, if that low has a wick, you got to grade it, because if you're wrong, chances are it's only going to go down into upper quadrant, consequent encouragement, or lower quadrant, and then reject on you and go the other direction. That's kind of like where you're going to fail, because you're going to expect that to be taken out, and it won't. It'll just trade into that range, and then that'll be the end of it. I mean, it'll go the other direction. Same thing here. You have relative equal highs here. Closest one to market price here has got to be rather lower than the one you're anchoring to. Anchor point is point number one, the higher of the relative equal highs, and anchor point to the relative equal lows is the lower one. If that low or high has a wick, if it has a wick, you have to grade that. And if you're in a trade, or if you're paper trading, or if you're tape reading and you're looking for it to run to that and go higher, always, always, without fail, never, ever, ever not do this. You have to take some kind of a partial. I like to use anywhere between the lower quadrant and consequent encroachment. So split that in half, and that's usually when I'm trying to take a partial there. That way, I don't have to have the high taken out. It doesn't need to do that. And it doesn't need to trade through consequent encroachment, because if it fails, consequent encroachment is going to tell you the information that you're looking for if it's going to fail. Because if it stops short of consequent encroachment and it doesn't even touch it when it runs up, that's indicating what? Weakness. It can't even breach the consequent encroachment midpoint of that wick. So if it's going to go the other direction, that's usually indicative of what you're seeing when there's a wick in the relative equal high and relative equal low. So the next bit of business in the morning, what I do is I go to regular trading hours and I highlight previous settlement regular trading hours. Okay, that's this price right there. So now that is regular trading hours opening range gap. It's not the high or low yet. I don't know that yet until I go back into electronic trading hours. Yeah, we're significantly higher than market price. So regular trading hours opening range gap high, and then you can copy that by tapping it, hold down control and drag it away. You can copy it like that, and then you can put it in close proximity where price is at, and then wait for the 9:30 opening, and then drop this on, but have it show below. And then once you have that, then you can drop your fib from the opening price at 9:30 up to 25,933 half, and then you can grade that opening range gap. That's the regular trading hours opening range gap. Okay, it's not new day gap. I'm sorry, new day opening gap or new week opening gap. It's just the difference between previous day settlement and regular trading hours to the regular trading hours starting. So Friday's settlement, regular trading hours, to Monday's regular trading hours opening, which is 9:30 Eastern time. Okay, so it's a huge gap there. And right away, what do you think is likely? It's going to want to explore up into that, right? And what else do we have up there? This week's new week opening gap. And we have first percent of fair value gap from January 7th. The new week opening gap for this week. And we have regular trading hours opening range gap all the way up to essentially the low of this week's new week opening gap. Old data. I'm not even using the opening range from Friday. I'm not using the opening range from Thursday. Okay. These levels are just salient to me because they're impactful and they go back a full week. So last Monday's trading to now. So I'm looking at 5 trading days back, not counting today. Go back and you have a whole week of trading. And these are the most salient PD arrays that I'm interested in, my interest. It doesn't mean that if you have something else in your charts that's somehow less important. No, You have to take these concepts that I taught you and make them your own. What are you going to focus on? There's no inherent wrong way of applying what you're looking for, especially when you're in these lower time frame charts, because there's all kinds of opportunities. But knowing when the market's going to draw to them and what you're framing it on, the highest probability is what I've shown here today, where you're looking at the time aspect first, relative equal highs, relative equal lows. What happens if you go back through price action and there's no smooth highs or smooth lows like we have over here in Asia? Like, say these didn't exist here, okay? Say this wasn't so smooth. Say it was just this high, and this was just a continuation lower and didn't create this obvious where your eye jumps right to it. Then this high here, that would be a single high liquidity where that would be overnight highs. That's where I would aim for. But because these are smooth, if it's going to go here, how far can it go? It's going to clear up and disrupt this smooth area over here and make it jagged. And I think everybody watching could see that that was made jagged. And it's being held in that holding pattern I told you. It's being held. Why? Number one, there's no news. Two, it's ahead of CPI tomorrow and PPI on Wednesday. So there's a lot of reservation on the part of speculators. So there's no interest in the market running, aggressively either way, because it knows who's it or what is it. The market makers know there isn't going to be a lot of participation. So even if it does keep printing higher prices, because that's what it's doing, it's not buying pressure. It's just going to keep offering the price higher, higher, higher. It knows that market orders are going to come in, and it's going to print and allow your chart to populate and show that price level. Anyway, um, having an expectation of the market not really wanting to run aggressively one way or the other because they won't entice the participation. Okay, it doesn't matter how many contracts are traded. If the algorithm or market makers want price to go to a specific level, they will continuously keep offering it in one direction. That's the reality of it. It's not buying and selling pressure. You're just going to see whoever is getting filled at those market prices as prices being continuously offered higher, 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 or in deference to when they want it lower, when it's going lower. Okay, so try not to concern yourself so much with volume because volume is not pushing price. It is not. It's just reflecting yesterday's news. Where did people get filled and how many got involved in that move? Has absolutely no bearing. No bearing at all. Volume is looking at what already happened. I'm teaching you where the liquidity is it's going to draw to. That's not reacting to anything. That's anticipation. I'm teaching you to look at inefficiencies that are in price action that are not hiding from you. And I'm telling you where they're going to form before your low volume nodes even come into existence. So the point is knowing what you're looking for in terms of time, look back. How far are you going to consider your range? Why are you considering that range? Because all of the activity, the sentiment that was inside of London, Asia, and the same thing is done for the New York session. So in New York session trading, you would use the 9:30 opening to 4 o'clock close Eastern time. So if you're going to be an Asian trader, or if you're going to be a London trader, that's your information you would use overnight or during those hours. Look for the smooth highs and smooth lows, or look for singular highs and singular lows that were very dynamic, like we explained here. Okay. Anyway, the point is this: we've seen the market run to the liquidity that was outlined at the beginning of the stream. I didn't need to talk about it because it was right there on your screen. The prices ran up. Okay. We talked about how relative equal highs and relative equal lows are a factor in price delivery. It matters not the volume. I don't care how many people bought. I've never considered how many people traded at a particular price level. I don't care. Um, I don't care how many orders were filled above the Asian session buy side liquidity level that I've highlighted here. I don't care. And just because you have a volume shelf high and low and a point of control, my first presented fair value gap is the real control. Me teaching you, showing you where the session high and kill zone high and low, buy side and sell side liquidity, that is the real high and lows that it's going to draw to. That's the benefit of knowing what I'm teaching. It's not borrowing logic from anything else. It's just focusing on time first, so that way you can frame what it is you're hunting. Well, when I look at these pools of liquidity, session highs and session lows, inefficiencies inside of that, their setups, their draws too. But I'm looking for relative equal highs, relative equal lows in deference to the session entirely and the kill zone. It's not just the kill zone. It's not that. So if you go back through the whole entirety of session start at Asia, okay, so there's Asia session start at 7 p.m. last night. From this point all the way down to this low during London, right before 4 a.m., there are highs and lows in here, okay, that can be used for fair value gaps. That's not my first interest. I'm looking at where in that range from that low all the way up to the highest high of Asia. I'm looking for where is it smooth? And it's not as easy doing it this way versus when you crunch up your chart. Look how much more clear you can see how that's very, very smooth versus anything else in that range. You see what I just did there? And when you watch these folks and they're streaming like that, like you're literally, you have your nose to a tree and you're trying to see the forest. You can't see anything. You have to zoom out. Like you have to get a broader perspective. And by zooming out, it gives you a perspective that helps you quickly, without any doubt, where is the smooth edges that will be made jagged. And you do it by compression on all your ranges. See that? So you can see clearly that there's a smooth level. There really isn't any, well, that kind of is right there to me. I like that one. But this one is obvious. And it's about, it's in the lower half of the range defined by 7 p.m. last night, start of Asia session, to 5 a.m. when they close. All this business dropping down, relative equal highs, start at 7 o'clock in the morning. It's going to run and upset that distribution of shorts. They're protecting that with their buy stops. So that's buy side liquidity. And because there's no news, we're in a holding pattern. Look at prices done. Say that is what you're looking for if you're a trend line guy or gal. Okay. Midpoint is still that low and it drew down into that. Same thing here. Diagonal support, midpoint is here. So that liquidity drew down to here. We're back down into old lows, inefficiency, and first presented fair value gap of pre-market session, 7 o'clock to 9 o'clock in the morning. That window is this, that right there. So this is all anyone really needs if they're brand new and they're starting. If they just look at the price action just inside that window and look at overnight highs, overnight lows, overnight relative equal highs, overnight relative equal lows. They will be inside of the highest high and lowest low of the session sometimes, just like that Asian session buy side liquidity pool was. It's inside of the entire range that was overnight. So it's not just simply what's the high of Asia. You use that information. It can eventually trade to those levels, but inside of the range overnight, you're looking for where is it smooth? And the probability of it running to them vaults, it increases exponentially if it's part of or around a quadrant level of the entirety of the range. All right, let's go back to 7 start time. And this is a candlestick it started on, right there. So this is your high, and that is your session low, okay? And we're going to grade that high down to London's low, okay? So here is midpoint, upper quadrant, lower quadrant. So inside of the lower half, we're seeing that relative equal highs. Okay, you would look at it like this. Go back through that whole range of price action, and you should be able to see how that's very, very smooth. Okay, until this little business right there, that was smooth too. Either one of them would have been good, but because this one was disrupted, that was left. And then you see this price action here. There it is. So let's go back because we just opened up. Remember I was saying earlier, we have new week opening gap higher. Now we put this regular trading hours low on the opening candlestick. Open price right there. There it is. All right. And regular trading hours, you'll see that it's a discount gap. It's low. And the previous session or trading hours close is up here. So there's the gap. Okay. All that right there is the gap. We go back to electronic trading hours. Disrupted the liquidity I told you it would reach for. Traded up to and through first presented fair value gap from January 7th. We're inside of the Asian session displacement from January 7th, and I didn't get a chance to show you what that is. All right. So consequent encroachment, opening range gap has been now tagged. So there's your 70% likelihood before 10 a.m. It's done that. So if think about you have a carbonated soda, okay? All of a sudden you flip the tap on it, and what's going to happen? You're going to hear there's a release. Okay, well that is what's happening right now in the marketplace, where there's this big compression inside that range, but it's void of any kind of price action delivered to it at all during regular trading hours. Even though there's a big important thing here. Even though we traded through this area here overnight, and this is Asia session high rate there. Okay, so that's Asian session high. Okay, so the only thing they did was came down and disrupt that trend line, like I told you. That was your Judas. No need for it to go down into this business down here. Subtle little retracement, and then expansion into the outside. Real aggressive run into old PD arrays. Upper quadrant is here. Asian session high here. And then we have new week opening gap here, all during the same time that we showed on the daily chart that those relative equal highs on the daily chart, they are too smooth on the daily. So it creates this perfect storm where price will want to rush into that space where there's no real trading during regular trading hours. Again, let's go to regular trading hours and take everything off the chart for a second. We started trading down here, that price right there. And that gap goes all the way up to here. So you see how it's rushing back in. Okay, it's rushing back into this unpopulated area of price action. Even though overnight on electronic trading hours, it has already traded in this range. It hasn't traded up here yet, even in electronic trading hours, but it has traded where we're at here. So we're basically overlapping what electronic trading hours has already done. All right, let's go back into electronic trading hours. This candlestick right there, I was discussing how this is pre-market session trading time, 7 o'clock to 9 o'clock in the morning. This is the first presented fair value gap right there, right here, because it's taking out a high and its displacement above that high. And it's not this little tiny little separation here between this candlestick high and that candlestick's low. That's not the fair value gap. It's breaking through in the direction we already determined that it was a draw. We've laid out several things this morning while you were driving over here. The fact that we're opening low at 9:30, it's going to be a discount opening range gap. The new week opening gaps above us. The relative equal highs are above us on the daily chart. There's several PD arrays that are highlighted here. And there's so much of a vacuum price to want to go back into this area. Then it keys off of the level Dad talked about as the first presented fair value gap over here during the pre-market session hours of 7 o'clock and 9 o'clock in the morning. All right, so upper quadrant's now been hit. So we have the other remaining portion or last quarter of the gap between regular trading hours session close last week and this upper quadrant level. That does not need to be delivered at all. This right here is enough to prove the things I've outlined this morning, where it was going to go. Where's the draw? Where's the direction? Up. Filling in this area. Everything going higher. Everything reaching towards that level I talked about on the daily chart, those relative equal highs. They were on the daily chart. They were real smooth. If you consider the factors that we outlined so far today, like you say you were long off the first percent of fair value gap that I outlined at 7 o'clock start of pre-session time. Say you close your trades right here. You're done. You're completely out of the market. You're done. From this point here to where we're at right now, which is upper quadrant of the opening range gap. That's this level right here, okay? Full closure, the gap is up here. You have already secured the lion's portion of the move and the entirety of the present daily candle from low to high. Knowing what you're looking for, also when it delivers a big rush of a price run, like this did here, that run, because it was parabolic, it was real quick out the gate, and it's already done 3/4 of the move. That's this right here. 3/4 of the opening range gap between last Friday's closing price to where we opened on the 9:30 candle. 3/4 of that's already been delivered in a few minutes. Whether you close your entire position or partial, something should have been banked, because it can always have a retracement deeper than you're wanting to or willing to hold on to. High, high, high at the upper quadrant. Liquidity resting still at Asian session high. I don't need to know how many orders came in and bought right there. I don't care what the volume is. I told you the level before the market reacted to it. First presentation, nothing is superior to that. Nothing. I don't care who wrote a book about it, how long they lived, who they taught, how much money they made over here in this competition, how many things they're doing in the live stream. Precision is precision. I'm going to tell you what time it's going to happen. I'm going to tell you on what candle it's going to react off of, period. When I pointed and walked you to this candlestick, and I told you relative to time, that's the one that matters. That's it. That's the one that matters. Did I have to pull up any kind of volume and how many people bought them create that candlestick? No, because it's not important. So we have a bullish candle here that I don't care how many buyers came in during that candle. I don't care. That candle exists below that low, that low. We tapped into it here, and then right before the opening bell, they snatched all the liquidity, resting below here in the direction that we outlined because of the daily chart, because of the opening range gap. It's going to rush to get up in there, and the new week opening gap for this week. So again, here's where you would want to, if you have any position open still, you would want to take something off here, because we have done a run on Asian session high. So overnight highs have been cleared out. That liquidity has been purged. We went to another eighth of the range, not a quarter. Okay, so it's an eighth, and it's just got close to new week opening gap low and regular trading hours high, which is Friday's regular trading hour settlement price. All liquidity now is resting on the sell side right below that low. We've taken out highs here. We cleared Asian session high, and we're in striking distance, flirting with a run to full gap closure and a tap into new week opening gap low, which need not be delivered. All right. So anyway, I covered a couple things that I felt were important factors in doing what you're supposed to be doing in the morning before the trading times. How are we referencing time? What are the contrasts between session and kill zone? What is the importance of that? How are we looking for liquidity? How are we identifying the key levels that's going to operate under the guise of bias and session bias? In other words, what direction are you trying to trade in? And where is price going to key off of? How is it going to react? What is it going to do? Why should it do it? What specific fair value gap? Which one am I looking at? There's your low of the day right there. It ran to the levels that we outlined in advance. Previous session, first percent of fair value gaps, grading the opening range gap. We saw it run real quick to consequent encroachment, which is this level here, which is half of the gap. 70% of the time, you're going to see that deliver by 10 o'clock in the morning. So you right away, you have a huge advantage of knowing where that is, and the market will likely gravitate to that. Then, by including other factors like overnight liquidity by Asian sessions high. Can you see how that's not hard? That's a very simple thing. Where was the highest high in 7 o'clock in last night's time and 5 a.m.? Whatever the highest high is, that's the Asian session highs. That's not complicated.
Yeah.
I'm not saying I invented it, but I'm just saying go through the process of knowing what that is and then grade that range. If it's likely to be bullish, as we outlined, and we said we were looking for higher prices, we've been looking for higher prices on NASDAQ. There's a daily chart, relative equal high there. We have a big gap opening that's lower, so we're opening in a discount. We framed the logic on how retail would be using, supposed diagonal support and resistance, okay, and how they're going to target them, and they're going to draw down on that liquidity. And when they hit that, and it's in concert with first presentation of a fair value gap that displaces, it has to move in such a way where it's showing you not only a direction, but it's showing you a magnitude of the move, saying, okay, I'm showing you something, I'm tipping my hand to you, here it is. Like this is me showing you the beginning of the run, and now it's really going to take place. So when it does that relative to time, 7 o'clock in the morning, everything has to start there. If it's not framed on time first, you have a likelihood of being wrong. I'm not teaching you to be right. That's just going to be the derivative. That's going to be the outcome of doing what I'm teaching. I just showed you a masterclass today of what you're supposed to do every session, every morning. Where do you find the liquidity? How does it look? Where do you find it in the previous sessions? What sessions am I using for the trading session I'm trading in right now? I did all that today.